Welcome, you're on the Fringe show. I'm your host, Tatiana Zalan, and I go live every Friday at 2 p.m. Dubai time. The Fringe helps you to navigate the rapidly changing world and increase the odds of your success. Here we discuss technologies, startups, entrepreneurs, and mental models of successful people so that you too can take advantage of the opportunities in the new digital world. It's episode 47, and I decided to dedicate it to exponential digital assets and bear markets. Things are pretty ugly in the world of cryptocurrency right now, as you probably all know. I'm following someone on Twitter and on other channels as well. His name is Raoul Pal. He's a very well-respected macro investor, and he's recently shared how he thinks about the market, as well as blockchain and cryptocurrency adoption, value, and investment opportunities. His digital assets investment philosophy is based on exponential growth, network effects, and Metcalfe's law. And according to him, Raoul Pal's the job of an investor, of a macro investor in particular, is to predict conditions 18 months into the future. So he bases his predictions of these markets on two things primarily: network effects and Metcalfe's law. And what I want to do in this show is to question some of these markets and just to see whether his assumptions are right or wrong. For example, could there be anything wrong with Metcalfe's law under the conditions that we are in? And secondly, whether his reading of the bear market is correct. And could the current bear market, I thought maybe it's more than just another recession in a business cycle. So this is the two things that we're going to sort of explore and look at in this particular show. The views are my own. That's the usual disclaimer that I do not represent any official views of organizations or employers I'm associated with. I also want to say outright that it's not investment advice, although we are going to talk about investments. This Fringe show is only for educational purposes. So what I'm referring to is actually his a report that you can easily find in the public domain, and that's a framework that is published in the name of the Exponential Age Asset Management Company. That's one of the funds that he runs. And here he shares some of his experiences and views from an investment perspective. He started in the space in sort of full on in May 2020, as he says. And as he says here, I began to finally understand how to invest in a volatile secular trend that follows Metcalfe's law based around network adoption models. He then says that the key to understanding is that the adoption of blockchain technologies is the fastest adoption of any technology in human history. Its adoption is growing at nearly twice the speed of the internet. And the investment thesis that he presents in this paper is to capture the growth over the next 10 years and extract alpha. And I want to show you a couple of slides here because it's really better to see what we're talking about, how he thinks about adoption and how many users that there are going to be or maybe in the next 10 years. So let me do just that, share a couple of slides here with you. Okay, that's not very good. Let me try it again. Okay, this is better. I think this is starting to work now. Okay. Right, so this is what they are seeing here. crypto users, internet users. So the point of the slide is just to show that there is a lot of growth that he predicts. Faster, it's growing a lot faster than the internet users ever grew. And this model in particular suggests that there will be between 1.2 to 2.8 billion users of blockchain technologies by December 2025. And he's also of the view that central bank digital currencies will likely play a role in that. And then he goes on to actually value the network using Metcalfe's law. I'll show you this slide as well. That's he's saying there that he's using a formula which is an approximation of Metcalfe's law for Bitcoin in particular. It's number of active users multiplied by total value transacted in dollar terms, and that gives you network value. If you compare that with Bitcoin market capitalization and the Bitcoin network value model, these two models, that it's very clear that they correlate very much. So that tells us that it's probably accurate. And this insight, he says in this report, tells us several things about the overall space. First, the entire digital asset network needs to transact high values. Point B is it needs to have a growing number of users, and therefore C, if those two things combine, and that's very interesting, if those two things combine, the 20x in user adoption growth shown by the comparison to the internet is going to widely underestimate the overall growth of the network value. And he then says that my working assumption that is that 1.25 trillion asset class, as it is now or at the time of the paper, will be worth 2.50 trillion by the end of the decade as more and more assets go onto the blockchain. And then he also says, yes, and we also need to figure it out, to kind of factor in volatility in these markets as well. Now, that's his basic thesis. It's growing and it will be highly valuable for investors. He says that this is why this is the biggest investment opportunities we have ever seen. And what I want to do is to sort of maybe critically look at that, at two things, as I said at the beginning of this show. Firstly, the network itself, the network effect, Metcalfe's law itself. And then we'll look at the current situation that we're in. Are we indeed in bear markets, or is it something more at play? And this is, what is Metcalfe's law? Let's start with that. It's coming from Bob Metcalfe. He's one of the earliest internet pioneers. And this law, so-called law, it's not really a law, but an empirical regularity, was identified by him in early 80s. What it says is that systemic value compatibly communicating devices, that means a network of compatible devices, grows as the square of the number. And you see on this graph that after a certain critical mass crossover, critical mass point, then value starts to grow exponentially while costs remain linear. And that's very, very important. Before that critical point, it's not like that. The costs overwhelm the value that's being created by the network. And my final slides that there is here that I want to show you is that there are different network effects. One of them is indeed, as you can see here, is Metcalfe's law. And that's this red line here. And then there are other laws, Zipf's law, the blue line, Sarnoff's law, the green line, and Reed's law, which is the most interesting one. It's where really value creation goes exponentially and upwards, but it's very rare. It does happen, but is quite rare. So the question is Metcalfe's law the right representation of what we have in the case of Bitcoin and perhaps other crypto assets as well? I'll stop sharing my window right now. Okay. So let's get going. But there are some limitations of Metcalfe's law, and one of them is it depends on the assumption that the additional connections continue to provide value. And that suggests, according to Bob Metcalfe, inexhaustible or infinite economies of scale. And indeed, some authors, economists have questioned that. There was a lot of interest in this thesis. And they said, well, one of them, Jeffrey Rawls, pointed out that if the first users are the ones who place the highest value in the network, then one would expect the additional later users to provide less value. And if you don't take this into account, that you will likely substantially overstate the value of large networks. Back in 2006, we had a very interesting paper by Nodlisco and Tilly, which is quoted very often, and it caused a stir in technical circles. It had a very provocative title, Metcalfe's Law is Wrong. And what they were saying is that communication networks increase in value, do indeed increase in value as they add more users, but the question is, by how much? And they argued that Metcalfe's law, which states that the value of a communication network is proportional to the square number of its users, is incorrect. According to the law, value increases quadratically, while costs go up linearly. They said that a far more sensible representation of network effects is the so-called Zipf's law, which is not as exponential, not as going up. And it's a basis to justify the kind of rule of thumb valuation of general communication networks of size n. Zipf's law holds that if some large collection of elements is ordered by size of popularity, then the second element in the collection will be about half the measure of the first one, and the third one will be 1/3 of the measure of the first one, and so on and so forth. So if stated more generally, that means that the value of the nth item in the collection will be 1 divided by n of the first item. In other words, the value of additional items decays exponentially. And eventually, the benefits that we associate with further expansion of the network will no longer justify the cost. And if so, adding more connections will not necessarily make the network more valuable. This article in particular generated a lot of controversy, and not just between academics, but within technical people, technologists, and venture capitalists, and so on. It generated a vigorous debate over the merits of Metcalfe's law. And Metcalfe himself responded to this, that his law was more misunderstood than wrong. And he made two very important points. His idea was to highlight the importance of establishing a critical mass rather than prove that infinite returns to network size exist. So that's one point. The second thing is he said that Zipf's law also resulted in infinite returns to scale. And he then presented kind of an empirical analysis, which was redoing of the previous paper, particularly based on Facebook data, and that tended to confirm that growth more resembles Metcalfe's law than Zipf's law. What does it mean for digital assets such as crypto? It's not just a theoretical and some sort of academic debate. It's got real life consequences, and this is why I wanted to discuss it with you. What it means is that the inexhaustible returns to scale, which are present in Metcalfe's law, are more complex than we can assume. And if Zipf's law is more correct, so to speak, than Metcalfe's law, then we need to adjust our valuation of the digital networks, including Bitcoin and similar crypto. But this probably is less of a problem than the problem of the other problem that I want to address. Because if you think about it, as long as there is an exponential increase, whether it's Zipf's law or Metcalfe's law or Sarnoff's law, then we probably, will adjust our valuation, but it's still an exponential asset. But the alternative scenario is more concerning the the bigger picture. What are we having? What is it that's going on? And thus, the thesis of exponential growth hold for the unprecedented times that we live in. And Raoul Pal believes that we are in the business bear market of the business cycle, and many people probably would agree with that. And according to him, in 18 months' time, he thinks that the inflation and recession will be in their rear view mirror. So if it's indeed a cycle or perhaps something more fundamental going on, that's really the question which bothers me. I think that here in the West, we're definitely heading into depression, which will cascade to other regions of the world because of our interconnectedness in the global economy, particularly in the financial sector. And according to some analysts, this depression will be unmatched. It will be expansionary, and they're saying that expansionary debt-based Western capitalist system is definitely on its last legs. That's on the kind of macro context here. On the point of exponential technologies, the argument here is that all our economic models are based on growth, if you think about it. They're not based on decline. And exponential growth of technologies has been hailed almost like a universal response to the challenge, or any challenge that humanity faces. You have a problem, you have a technological solution, and only technological solution, and it's growth-oriented. If you take singularity, many of you will be familiar with this concept, and that's the idea that superhuman intelligence will be created because of technological progress that's based on another law called Moore's law. Let me give you a little bit of an alternative view. Back in 2018, there was a closed by invite conference in Santa Fe at the Institute of Complexity, organized by the NSA, National Security Agency, and it presented 4 scenarios for global development: optimal, revolutionary, catastrophic, and anthropological transition. The optimal and revolutionary scenarios were rejected for reasons I don't have time to discuss today, but most of the participants voted for the catastrophic scenario. And there were only really serious people present at this conference in Santa Fe at the Complexity Institute. So what do we see now in 2022? It's the combination of the pandemic after effects, hybrid war, food supply crisis, migration crisis, financial crisis, supply chain crisis, and some people will say climate change crisis. And all that means that every single industry will be in decline, although at different speeds. That's according to some views, of course. Not everybody will subscribe to it. And some analysts also predict that there will be a sharp decline in exponential margins associated with winner-take-all firms or monopolies like Facebook and Google and Amazon and Apple. What we have now, they're saying, and probably this is something for you to think about as well, is this is more than just another financial crisis or economic crisis. It's a systemic crisis of capitalism, and therefore it will be a lot deeper and more consequential than what we had in the 1929 and 1933 crisis. And this crisis in particular will be inflationary. The one back in the 30s was deflationary. And this is judging by what the Fed is doing right now in increasing interest rates. So 29, 30, that was deflationary. And that was because of the gold standard in the US. They couldn't just emit more dollars. And it's arguable until when that particular last depression, the 30s, lasted. But some analysts and historians and economists are saying that it lasted until the war started, 1941. So if we take this for kind of a benchmark, then we can definitely say that current inflation is going to last way more than 18 months, as Raoul Pal suggests. In addition, we're transitioning, as we know, to a new economic order. It's a multipolar world, and the center of this world is going to be Eurasia, some will say Southeast Asia, but it's definitely around China and India and Russia, Japan, Korea, and Iran. This transition is expected to be accomplished by something like 2025. If you take India and and China only, that's already 2.8 billion people, to be precise, and they're not very open to digital assets. India is kind of sitting on the fence, but China in particular banned cryptocurrencies in September 2021, most likely because they were facilitating capital flight from its markets, bypassing conventional restrictions. It's likely that crypto and blockchain adoption come from these markets. Is it likely to be that? So that's a question mark. I don't know. It's time will tell. If depression happens, then most people will stop thinking about digital assets for sure. They will be thinking about real assets, land, clear water, food, their own health. They will become the real assets in the next that really count. Business investment in blockchain will most likely decline as well. This catastrophic scenario, I understand it's all doom and gloom, but it's realistic and it's based on historical regularities. As we know, history doesn't repeat itself, but it rhymes. So what will need to happen if Pal's thesis is correct? Is the genie out of the bottle and cannot be put back? That's a question that all of us need to be asking. If we adopt a broad heuristic, then all analog processes that can be digitized will probably be because of efficiency and cost reductions. The key question, however, is what will cause adoption and growth in digital assets on blockchain? What are the use cases that will drive adoption? Raoul Pal suggests that all equities and bonds, foreign exchange assets and derivatives, real estate, and a large number of legal contracts, all of those will be moved to blockchain. One can also add that blockchain will probably provide full transparent financial ledgers and, of course, the notion of building applications around digital scarcity like NFTs, and Bitcoin itself is a scarce asset. There are expectations that the world will move away from sovereign debt as a primary store of value, which it is now. And there are currently something like $13 trillion in global foreign exchange reserves alone. That wealth needs to be moved somewhere into something that cannot be debased or maybe seized, and that may well be the digital assets such as Bitcoin and Ethereum. So just in conclusion, I personally would like to think that Raoul Pal's thesis of exponential growth in digital assets governed by Metcalfe's law under conditions of volatility is right. And the alternative catastrophic scenario is wrong. And humanity will somehow find its way through this awful crisis. And that's because I have skin in the game and I own digital assets, and I want this scenario, more optimistic one, to be true. But I'm just wondering, what do you think, based on your understanding of the trends and trajectories of technology evolution, and generally speaking, all this macroeconomic and geopolitical context? What is the most likely scenario? I would be really interested to hear your views. Well, anyway, thank you so much for joining today. And I will be on air on the Fringe show next time at 2 p.m. next Friday, Dubai time, 2 p.m. Okay, thank you so much again. Let's hear some music now.